All right, well, let's get started. Again, welcome everyone. My name is Glenn Thompson, and I've just initiated the recording, so we will officially commence. Welcome all, for those of you who are familiar with previous presentations, as well as those who may be a first-time subscriber and checking in. Glad to have you, and you can access the control panel area on the right side of your screen if you want to indicate comments as we go along, and I'll do my best to, in a manner that won't interrupt the flow, respond to such, but I believe we'll have sufficient time at the end of the presentation for more comprehensive addressing of any questions or comments you might make. As you see on the screen, I'm Glenn Thompson. I've been working as a mentor with Pacific Trading Academy since the beginning, 17 years. I've been trading for more than 30 years, and you can get more information about what I do and our programs in particular with the information you see on the screen, our website, www.pacifictradingacademy.com, as well as the toll-free number 800-339-8588. Today's presentation is intermarket relationships and current trades. So let's begin. I'm going to outline 3 or 4 specific opportunities that I see, and these are all position trades. It's logistically more challenging to indicate higher frequency or intra-period, shorter-term trades, but I do that for the people I consult. But these are, by definition, going to be some swing or position type opportunities. Here we are, just moving into, we're still in the first quarter of the year, and we have plenty of opportunities that I think, and 3 or 4 stick out. Some of which I've already gotten established position-wise in the markets, but even to that extent, if you are on the sidelines, I think there's tremendous opportunity for the next, into the middle of the year, if not beyond, certainly for through the first quarter. So let's begin. Timing should always take precedence over price. For those of you who have seen or listened to anything I've had to say over the years, or if you're familiar with my analysis, I place a premium of importance and attach a great amount of significance to market timing. I realize that's a minority view. I do subscribe and buy in and utilize the primary fundamental foundational precept of all technical analysis, which is that price discounts all information, the information that is known collectively and even information that we're not aware of, that's unknown. By definition, that is the first and foremost foundational cornerstone or keystone of all technical or analysis. But from a cause and effect, and so it is a fundamental precept, I align with my price or trend analysis from a standpoint of what I determine to be a primary driver of price action. I believe time period analysis plays a critical role in enabling me to identify with more accuracy why markets are doing what they're doing. So this is just a slide to indicate that. From a capital flow standpoint, money flows towards greatest rates of return. That's also a fundamental concept. By the way, these 2 initial precepts that I'm emphasizing as a precursor to the trade ideas and market relationships I'm going to present in today's program indicate I'm not oblivious or I'm not against fundamentals. It's just a type of information. I want to incorporate all information that I think will have an impact and inform market motion. It's just difficult for me, or it has been difficult throughout my career, to consistently profit solely on the basis of fundamental relationships. When I began to incorporate technicals and augment the fundamentals, I generated higher returns more consistently, more often. This is just an indication of some basic set of relationships intermarket-wise. Again, the U.S. dollar, as goes the U.S. dollar, so too do the various capital market sectors of an economy, whether it's the domestic or worldwide. Commodities, bonds, and stocks are the primary components of the financial economic foundation or system. So if you have a strong dollar, that tends to put pressure on commodities bond prices move or bid up, and so too are stocks. When you have a depressed dollar, commodities are able to move up. All of the variables isolated or fixed, let's say, bonds decline and stocks decline. That's not always the case, but 80% or so of the time it's a good, more or less intermarket embedded relationship. And then you have to adjust for deflationary or inflationary periods as well, as you see on the screen. So I just wanted to present these basic kind of intermarket correlations that we can utilize as a backdrop to provide context of the technical analysis that we do. The first opportunity that I see for a number of factors is the dollar, the US dollar. I don't trade the dollar index. You can, but there are indirect ways you can trade Forex pairs. I do a lot of Forex trading. In the last week, I've done 2 shorter term trades in dollar yen. The first one was a long, then the short. Just got out of a short earlier, a couple of hours ago, very shorter term. But or you can trade the euro against the the dollar, but or you can trade the dollar index, or you can do an ETF if you're on the security side. But essentially, this is a long-term weekly chart, or going back 5 years, if you consider that long-term, with a basic overlay of a plausible wave pattern or count that I've put on it. So it provides my reasoning, or it does provide a explanation as to why I believe or hold my current view for the dollar. Longer term, I'm bullish the dollar. Immediately, though, and when I say immediately, between now and the next 4 weeks, let's say, we've got a Fed meeting coming up the middle of March 15th, I believe they start. I'm not sure if it's a 1 or a 2-day meeting. So essentially, it's a month from now, or from yesterday to be exact. But you can see the top here. What's important immediately is where I have number 5, indicating the end of a 5th wave, and we've been going down since then. I believe we are in a correction phase right now, and I believe the correction will last, have a duration through that meeting, at which time I expect the Fed will be raising interest rates, barring some calamity or catastrophic event. I expect there will be an increase in rates. Janet Yellen at the Fed just had a testimony 2 days ago before Congress, and more or less intimated such, equivocating to the point where allowing herself an out in the event we have a collection of bad news of economic data between now and then. But barring that contingency, I expect I would say about 70% conservative probability for the Fed to raise rates at the meeting next month. And if that's the case, that would be from a fundamental viewpoint, a catalyst or a trigger that would serve to lift dollar prices. So that's one fundamental factor that reconciles with the chart. So this is the, excuse me, this is the longer term weekly view. Let's look at it more go to the ground level. This is the daily of the March contract, the front month and the futures on the US dollar index. So more or less you have kind of a fractal of what the longer term view that I just marked off a little basic wave count here. And so here, if the top of the chart, as indicated with number 5, marks the end of the bullish portion of a cycle, then the move down we've seen since that top, just above the 103 area, or 104, actually I guess closer to, through the recent bottom about a week or 2 ago, the first week or so of February. If that's it's either an ABC in its entirety, in which case we're going to go up. So there's a reason, based on an Elliott model, why I would expect the dollar to be boosted and bid up in price. If that's not correct, an alternative count is to assume that the bottom we see in the first week or so of February is just the A wave. Well, if that's the case, the reason we've seen the market rise in the last 2 weeks is it's forming wave B of an ABC 3-wave correction. By the way, let me just interject this, folks. If you're not familiar with Elliott wave, don't worry. If you are, great, and you probably, I'm sure, are with me with what I just said. If you're not, that's not the purpose of today's presentation. Again, is not to present a primer in Elliott wave or any such model. It's merely to present an argument and a set of conditions that I feel will, in aggregate, serve to generate or is an argument by explanation as to why I'm expecting certain markets or instruments to move in a certain way. Because of a certain pattern that is in a part of a tantamount to a certain model, I expect that the markets, that bottom that we see at point A or C here, is either the end of the entire corrective portion of the market cycle or it's just a fraction. In either case, it accounts for price action to the upside. Now, short term, what do I mean by short term? Notice this vertical line here. This is a projected time point. Remember the slide 2 slides ago where I said timing takes precedence over all else in analysis? Well, for me it does. Less than 5, I'm in a minority of traders that believe so. But on that basis, if you just go with me a little bit here, if we believe that market price action is a direct correlation or function of certain specific amounts of time elapsed, well, here's the importance of what I want to show you. I have projected for the US dollar a time point coming in on March 14th. I did this week, sir, if not months. I don't remember when I did it, but it was some time ago. Nevertheless, that's neither here nor there. What is important is I have at least an 80% degree of probability of correlation attached to this date reflected. If you can see that yellow line, but I have a little flag coming off to show the date of March 14. At the time I generated that date via a series of different types of analytical projection methods. I use everything in my repertoire in my toolbox. That's basically Gann type analysis if you're familiar. But market timing would go under that umbrella. So essentially I came up with this date of March 14th. Immediately on deriving that date, I realized I didn't, shortly thereafter it came to me, I said, oh, is it coincidence that the Fed meets the very next day? So assuming a margin of error, 1 or 2 days, 24 to 48 hours, it's essentially the same data point. And as such, there may be a congruency that could occur in and around that point in time or window of time at minimum. Okay, so if I'm correct in my assertion that the Fed, if in fact the Fed should raise rates, that will immediately tend to have a knee-jerk, visceral kind of response by the currency to support it. And so my short-term view for the dollar, when I say short-term, is between now and the middle of next month. So assume between now and for the next 4 weeks until we get into March 15th or the 14th and or one and the same, I'm expecting declines. Why am I expecting declines? Well, let's consult our wave count here. If this bottom that you see labeled at point A or C, if it's an A, I think the move that has risen to yesterday's or the day before yesterday, this was printed out last night. So that top, the highest point after the bottom at A or C point is corresponding to yesterday's high price. We have, I believe, let's see, that was at 194 just a minute ago. The market declined overall. We're closed at about 148 today. So a slight decline for the persisting the price action we saw. This is the overnight market, this little gap down, and we closed slightly lower today, just under 150 at 148 basically, just literally a few minutes ago. So we further declined, and so short term between now and the middle of next month, I'm expecting declines. In order to form, if this bottom here is a C wave, this move up would be interpreted as potentially a new bull market cycle, the first wave, wave 1, in which case the decline would be defined or labeled as a correction wave 2. And I would expect its duration to more or less coincide with the, between now and the middle of next month when the Fed meets. And if I'm correct in all of these little disparate pieces coming together, should the Fed raise rates, that would mark the completion of the correction wave 2 and simultaneously the onset of impulsive wave or motive wave 3, taking the market higher. So after if not before, after the middle of next month, that's what I meant by my longer term view for the US dollar, I'm bullish. But between now and then, I'm more or less bearish, at least given all the data points I'm aware of currently. So strategies that would exploit for the short term, again, the short term meaning between now and the middle of next month, the short side of the market are what I would be doing. If you have a longer term horizon, look at the pullbacks that we're expecting as opportunities to buy the pullback commensurate with a longer term bullish view. You see, so that's a strategy. One way or the other, you can either trade the dollar index, the futures contract, an ETF. I forgot the symbol. I think it's UU. I'm not certain, but there are ETFs that more or less are efficient trackers, are mapping the price of the dollar currency, or you can do it on the Forex side, trading dollar yen, dollar euro, USD, British pound, etc., or the Swiss probably. Yeah. Okay, so that's an immediate situation I wanted to point out. And as the dollar goes, so too will the commodity sector, so too will the paper asset, equity, and bond or treasury interest rates as well, as we'll see. Okay, if given the Fed is going to meet next month, the bond market, treasury instrument, interest rates in particular, whether it's short-term 10-year note, whether it's longer out on the curve, the 30-year, etc., we can have immediate consequences in these instruments. This is very important. This is this is a trade that really, it just dawned on me in the last 48 hours as a position trade again. I was talking to someone yesterday, and I mentioned that I had a time point in the bond market. Let me switch. I'm going to come back to this in a second, but I had a time point on February 9th, which was right in, I think, here, or right, whatever day this 9 is. That's a misprint, forget that. But February 9, I did not mark it. I had a turning point into it, and I should have shorted the market. But that being said, I am now bullish the bonds, short-term and long-term. So that's the trade I would be doing immediately. I missed the previous opportunity from about whenever February 9th was, about a week or so ago. Whatever this date was, it was a perfect turning point. Whichever one of these days is the 9th, but I had a projected time point for February 9. In principle, my interpretation arose out of asking what was the market trend at the time it arrived at February 9th. It was rising, and so assume initially, it's a little simplistic, but it's a starting point of assumption of analysis. You're going to assume that the market, and once it reaches or runs out of time, and that the running out of time occurs at a time point if it's a reliable piece of information. And so I did not take that trade. For other reasons, as I'm going to explain, I am bullish the bonds, and that's a trade I would be doing right now, one way or the other, establishing long positions in the 30-year and or the 10-year. The geometry of the analysis is applicable to both the longer term on the curve or shorter term. The 10-year notes or the 30-year instrument are both appropriate instruments in this case. Not always the case. There's sometimes going to be discrepancies and so forth, but right now I like the long side of rates, interest rates, short and long, notes and bonds. Okay, let's back up and show you why. For a number of factors, the wave count, the structure, the trend analysis, and I want you to see another relationship. And I'm not sure if I call this technical, fundamental, quantitative, or some hybridization of all of the above, or neither. It is what it is, but if it's a correlation that proves my overall edge, so be it. It's the commitment of traders. Notice a very rare situation is this is the weekly chart of the 30-year Treasury going back 5 years. I want you to see this top here is number 5. That's referring to the Elliott, and then everything we've seen after. I think this is either an A, similar to what we saw in the U.S. dollar. The entire either it's just an initial leg, that 1/3 of the overall correction, or it's the entire ABC correction. Well, I happen to, if I'm going to split hairs, I believe that this bottom is more likely the end of the entire correction. If it's just the A, and this move up here is the B, which is, would have to be of a zigzag, and then that augurs for a much deeper correction eventually. I doubt that's going to be the case. It's not impossible, but I rank it less than 15% likelihood. So what's left to assume, given the structure we see? I'm assuming that this move from number 5 to what I am labeled A or C is C, more likely a C. Well, if that's the C, it completes a cycle that began back here a few years ago. Here's your 1, here's your 2, here's your 3. The sideways consolidation is a classic 4 up to the 5. Your A, your B, your C. If that's correct, the move off of this bottom labeled A or C, and assuming it's a C, is the new start of a new cycle, a wave 1. Again, similar to what we saw in the U.S. currency. And then the move down we have been seeing overall for the last month and a half or so is a correction. I believe correction 2, wave 2. And then once that is complete, we're already at about a 50% about a month ago correction. Not saying it can't go deeper, but assuming at whatever point it ends, if it has not already done so, that would mark the onset of a wave 3, taking this to much higher highs. So that is an Elliott description and reason for my bullishness in the Treasury rate instruments sector. On top of that, completely separate idea, notice this red line down here. This is the Commitment of Traders report issued every week. And essentially the red line represents the commercial activity. The green are the large funds, that's large specs. The blue, critical to understand this blue line, if you can make that out, that's small traders. And there are definite relationships. Commitment of COT, or Commitment of Traders analysis, is a subspecies of analysis in and of itself. I'm not going to make a decision solely on it, but as a complement and an augmentation of other things I look at. But there are times when it has a very rare reading or relationship, and this is one of those times. Rarely do you see, well, here's what I want you to see. Notice from this middle of right at the end of whenever this is, it looks like the middle of, well, from whatever that date was. Here's the point I want to mention. We are currently, for the last 6 months or so or more, at the highest net long position held by the commercials for the last 6 months or greater. This is going back to I think the middle of the summer, end of June or something, middle of July or somewhere in there. So for the last 6 months, what is important, not only the current nominal level, but the trend. We are at the largest net long position held by commercials for the last 6 months. By itself, that's ostensibly bullish, okay, but not enough to place a trade or even make a trading decision, much less put your money on the line. Okay, here's the interesting relationship that's powerful, that it supercharges this commercial position because it's so rare. So rarely do you have, more or less, it's not perfect, rarely in the real world are you going to get perfection in relationships, but it's a close approximation or semblance to what's a very powerful relationship, which ramps up the possibility for an abrupt move sooner than later. And that is, you have a more or less mirror image on the part of the blue line. That's the small specs. Most often you see, whatever the extreme position held by commercials, the mirror image is by the funds, the green line. That's large institutional traders primarily. But when you have that mirror image, well, so you have that currently with the institutions. They are mirror image positioned. They are net short, more or less, in polarity with the commercials, but so too are the small specs. 85–90% of the time, small traders, small specs as they're referred to, are wrong. So that adds that would cause me to place that much more confidence in the extreme position evidenced by the commercials, the red line. And this is extremely bullish right now. Notice, if you will, the precedent for that. Notice when the commercials going from a few years back into the lowest point you see on this screen, on this chart, while they were moving to that lowest net, the largest net short, well, that's what I mean by lowest, largest net short, the market was moving up. The standard typical mode of analysis of interpreting price action with respect to commercial activity is interpret the commercials as a harbinger, a forecaster, but leading. The catch here is what's the lag time. It's anywhere from 3 to 6 months or more. That's indefinite. We need other factors to help more precisely do the timing. Nevertheless, as a qualitative reversal indication. Look at the commercial evolution relative to the price. The price was reaching this high at point number 5 while the commercials were achieving and attained their largest net short. The moment it did that, notice how the market went into the correction. I submit the opposite is about to occur. We are at the largest net long on the part of the commercials, and corresponding I'd expect a bottom to occur, which I think it's already in, but a secondary bottom marking the end of correction wave 2 from the vantage point of Elliott wave analysis, and the onset of what would tend to be the most explosive portion of the market cycle. Okay, now adding to that, again, less than 5% of the time for the spectrum of markets, all markets, for a course of any year, during the period of an annual year, would you have this relationship where the small traders, when that happens, you can make money on that alone. I'm not suggesting you should, but in concert with all of the other relationships, this is a recipe for an explosion to the upside. Not being a harbinger, don't want to be prophesying any gloom and doom, but in general, bad news is good for bonds. So be that as it may, also notice an important relationship as the market was going. We noticed this sudden decline in open interest, that lavender line, if you can see it. It's a small point, nowhere near as important as the point I want to mention on the screen, but it is indicating that we're nearing the end of this correction move down and about to another small factor in alignment with looking for a bidding up very quickly. So that's a trade I would look to establish longs in the bonds, both short-term traders and long-term. That's the trade I'd be doing, trade of the week, if you will. If you haven't already, this is one tangible, practical trade, regardless of your chosen time horizon, because of that factor as well as others. Okay, this again is the same chart. Here we have a little more, just a larger scale, same scenario. This is this bottom right here. Okay, this is the same situation. Look at this is the bottom. Let me just coordinate that so you can see back there. That would be right in here. This bottom right here, if you can see, I'm not sure if you see my pointer, that's a month ago. That's 1, 2, 3, 4. This is 4 weeks in from the right. This is a weekly chart, so each vertical bar corresponds to a week. So that's corresponding. This is a daily chart, same market. This is the bottom. This is one and the same data point at 147. We've moved up. As I said, I had a time point and then back and forth. This is a little odd structure in here. I admit that. Someone pointed this out. Well, I was discussing this with a colleague yesterday. It's odd. If this is wave 1, this could be A, B, C of 2. And 2 could decline a little further, so keep that in mind. But look at the relationship that the longer-term weekly chart illustrated. Look at that commercial red line. We are at this is just a blown-up version, if you will. Notice we are currently at the largest net long position held by the commercials, represented by the red line, and simultaneously, and this is I cannot emphasize this strongly enough or often, very frequently you see this. It's not unusual to see the commercials at an extreme one way or the other, net long or net short. That's not what's the sticking point, the important issue salient here. It's very rare that you have the commercials at a extreme point and simultaneously the blue line, the small traders, polar opposite. When you see it, it's a recipe, as I said, for a very soon, if not already in the works. It's brewing. Something's going to happen. I don't know what it would be. It could be anything. There will always be correlates in news and fundamentals that serve as the triggers and ultimate catalyst to initiate a move. But at least we have a lookout. We know that the Fed is meeting in a month from now, a month to the day yesterday, but watch out. Something or things will conspire on that level, on the fundamental front, to bid up the price of interest rate or bonds, nominal bond prices and treasury prices, etc. Given this relationship, also notice your rising open interest here, reflecting more recently, and so that's indicative of new buyers coming in, establishing, and that will tend to be a more persistent move versus old sellers coming out. rising open interest, rising open interest for any type of trend will tend to correlate with a higher persistency or duration of the move. So that's the trade of the moment, long position in the interest rates. Okay, this is just a general review. So, quick review, interim. If bonds go up, now here's where the short term, again, it's consistent. What did I say? Short term, I'm bearish the dollar. What's short term? Between now and the next 3 to 4 weeks until the meeting, at which point I expect a turnaround in U.S. currency price. And while that's occurring, we could have appreciation in oil, in the energy sector. I'll get to that in a subsequent slide. Metals, I'm already established long. I am quite bullish in both gold and silver. Pick your poison, I'm fond of saying. Stocks, this is iffy because of something else. This is another important trade. Longer term, I'll say for the record right here and now, I am quite bullish on the stock equity sector in the U.S. When I say longer term, going out for the next 2 to 3 years. Now, that has more to do with some regime macroeconomic componentry that I suspect is at work, population studies, but that's purely fundamental. Short term, I have a bias as well as it's one of the trades that I'm indicating as of where we are right at this moment. I have a bias to the downside, but I'm going to address that in a few minutes. So now's a good point. Any questions? Let me just take a quick time out to see. Are there any questions? UUP is dollar. Oh, thank you, Bob. Thanks for that. I don't trade ETFs. I trade the underlying futures, and I used to trade stocks and equities. But yeah, UUP. Thanks so much for that appreciation. Hi, Vin. Okay. All right. So any questions just before I proceed? Okay. Great. If there are, you can in the right side of your screen, the control panel area, you can make a comment or question if you have, and I'll attempt a little to intermittently address that if I can, if it makes sense and won't too severely hinder the flow of the presentation. And then we'll have time, a few minutes at the end of today's presentation for more comprehensive addressing. All right. So let's progress. So this is another immediate trade. This is the stock market. This is the March S&P. By the way, just so for those of you on the security side, if you trade equities or a stock or ETFs or anything under the jurisdiction of the SEC versus the CFTC, or regardless of what I'm about to say pertaining to stocks or equities in the U.S., is universally applicable. It will apply to any major stock index, SPY, SPX, Dow Jones, YM, NASDAQ, Russell, S&P. I tend to trade the ES, the E-mini S&P, but all of the above. That won't always be the case, but in this case, more or less it will. There are going to be divergences and differentials between each of the major indices I just mentioned. They are going to be they will be overwhelmed by the preponderance of and confluence of evidence I expect will serve to provide the primary catalyst and trigger for the broader equity sector. There are going to be differences. Specific strategies you would develop will necessarily take into account the particulars that define who you are as an investor and a market participant, i.e. your money, your resource level, your equity, your tolerances for risk, the particular style, etc., what differentiates you from one participant to another. Barring that, however, more or less, this is my scenario for the broad stock market. I utilize the S&P. You could use SPY. This is the proxy that I utilize, and I actually trade long-term and short-term. So what do we have here? This is a chart going back about a year of the S&P. All right, daily chart. Here's a quick wave count. 1, 2, 3, 4. There's your little A, B, C for those Ellioticians out there if you're interested. That detail is not really what I want to focus on. Here's what I want to focus on. And I sent out a transmission to all of the people who subscribe and I consult, as well as those who have been on my mailing list for years, yesterday. Because notice the vertical line. These vertical lines are time points. These are just graphics to illustrate that it's a database of dates. This is vis-a-vis the timing that is so critical and essential to what I do. Again, if you're coming in late, I am not suggesting that I make decisions solely on timing. You could, I think in the best of all worlds, it's you make your trading decisions and you derive your views analytically on a confluence of different types of information, and so as to hedge your analytical outcomes and bets. But having said that, I personally place a premium of importance. I believe that trend and price does discount all information. So at the end of the day, it is the central component of all my analysis. Yes, clearly. However, a close second, and what it does that the price analysis alone singularly does not provide me is insight and clarification as to why a market's doing what it's doing. Okay, I happen to take an extreme view. I'm in a minority, and that view, which is so extreme, is that all price fluctuation, from the most micro, nano, minutest to the largest, if you're a hyper-frequency day trader to the longest term investor, from tick charts to monthly, quarterly, yearly charts, and every time window in between, my personal view is that the reason you see all of the price structure and type of price return that you see and experience and observe and trade is due to certain specific time periods that have elapsed. The basic cliche or market maxim for timing is that a market will do what it's going to do only once its time has come. And so that's the maxim that I go by. So, and again, I'm going to combine that with all of my price analysis. When I arrive at a time point, the interpretation response should be, look and see what other phenomena in relationships from the vantage point and perspective of price are occurring that are reinforcing and consistent with the arrival by the market to a certain point on the temporal dimension, timeline. Okay, but suffice it to say, these vertical points point out past and future time points that my analyses tools have generated. So this, just to give you points of reference, to give you context, these vertical lines are dates that have come and gone. They're of no practical value other than for illustration as to how they might have worked in the past. These are the future, this is the past. By the way, this was June 27. The reason for the decline fundamentally on that level, superficially if we're interested, remember the Brexit. That was last summer. Okay, this was a perfect top or bottom but it's not as significant, so I'm not. But this one was very important to me. It was precise, could not have been more accurate. It was November 4. If you recall, that was the Friday before the presidential election in the U.S. This big tail is the volatility ensuing and responding to the uncertainty involved around the election. We got long based primarily on trend factors that were substantiating and working in concert and congruent with my time point of the Friday before. I remember thinking that afternoon it would take a lot of kahunas to go long in front of the election. But essentially, here's what we did. I got long that Monday, the following Monday, got stopped out due to this volatility and re-entered like later, I can't remember if it was that Tuesday or whenever, shortly in there, I got long again. So we didn't get long exactly at the bottom, but it was primarily due to that projection of time point, November 4. I remember at the time I projected November 4 as a time point, I was not thinking about it. And then as I got closer, it was months before, when I got closer, I said, oh, I realize I'm probably off early by a few days, barring the weekend, because the market's not trading. But I said it's the election. That would be, so I remember saying, someone asked me on a radio show about a month before or whatever, a couple of weeks before the election, one of the questions that was presented to the panel was, who do you think is going to win the election? I said, well, I have no idea. And I truly didn't. It was uncertain. But I said I am 100% very certain that whoever wins, the market, the stock market that is, would like it. Because I saw the trend, we had a triangle. I construed this to be, this was wave 3 up here. This is 3. This was a particular wave 3, not this wave 3, a different degree. And I saw the trend moving down into this point. So if I had this is how it allowed me, I could not in an explicit sense make a forecast as to who, Trump or Hillary, would win the election, but I could make a forecast insofar as the market's response, given my interpretation of what the trend was doing, and on the assumption that it would continue to slide into that time point and expecting a turnaround as a response. That's why I said with absolute certainty, whoever wins the election, I can't tell you, but I can tell you guaranteed the market will be bid up and like the winner, or like the results. And so far you can see what's happened. Okay, back to the slide. This is what's important. These are past dates. This is the date of yesterday, February 15th. So we're kind of right here. So this is why I am expecting, and I sent a memo out yesterday to this effect. We have a time point, February 15th, so assuming we're still kind of feeling the impact, based on time analysis of the market. So I'm not surprised that we kind of did nothing today. We're kind of actually right there. Market close, the S&P closed at 23.46 1/4. Yesterday's high, curiously, I believe was 23.51 1/2. My price target that I'd worked out about a week and a half ago was 23.50 even. So basically, the principle is, this is Gann analysis also, when time and price collide, you have your best reversals or your best opportunities for entries and good trades, high value areas where we can expect a good return to reward risk opportunity for an entry. And I believe we could be at one of those junctures right now. Okay, now adding part of the analysis that allows me to expect this, and that in fact this is a time point, this date, February 15. Notice, just for clarity and context, these are future dates. I don't know the veracity. I can't say. Let me put it from my vantage point. I don't know how this will manifest or how accurate they will be. I can tell you this. This was dead on June 27th. This was November 4th. This was dead on. It was not as tradable a move. These were not as accurate, but to the extent whatever tools and models and relationships I exploited to generate my historicals, I've done the same and applied the same to generate the future. So I would place at least 75 to 80% confidence in the reliability of these future dates. But we are at present right here. Today's the 16th. Here was my theoretical, February 15th. Keeping in mind an important event on the fundamental front 4 weeks from now, the Fed meeting, which is interesting, okay, by itself. But that aside, we have from Elliott theory, a particular component embedded in the Elliott model is this idea of embedded or stacked fifth waves. And this is one reason why I think we are at potentially an important top in price action in the stock market. If this is, this is actually, this bottom here is December, if I remember the date, December 17, 2015, and or roughly thereabout. White wave 1, 2, 3, and then here's your 4. Okay, if this marks the end of a particular fourth wave, it's the start of a fifth wave, and so everything to the right is a fifth wave. And so those of you who are aficionados and understand Elliott theory, we understand that all fifth waves subdivide into 5 smaller degrees, and so on and so forth. The principle being, when you have a stacking or embedded number of fifths, that will tend to mark a terminal point of significance. To be more specific and quantitative, when you have 4 to 6 fifth waves that are embedded one within another, 97% correlation, you have reached a terminal point, or that market has achieved a terminal point. So if there's anything correct about my description, my wave count, if this is marked truly the bottom on June 27, again, if you're a fundamental perspective trader, that was Brexit, the end of Brexit. If everything marks a particular fifth wave, then there should be 5 little segments inside of that. 1, 2, this is the 3, little triangular fourth, into this smaller degree fourth. And everything to the right is this is a fourth within this larger, everything to the right represents a smaller degree or size or scale fifth inside of the larger fifth that began from June 27, and so on and so forth. So you can see the succession of fifth waves that I have stacked up here. Here, if this is all price action that marks a little embedded fifth inside of or encased inside of this larger fifth, there should be 5 little waves inside of that. I see structure that's commensurate with that. This could be the 1, this could be the 2. This, notice how it went almost vertical, very characteristic of third wave type price action. That could be the little 3, and voila, well, what do we have here? Another little 4th, marking the onset of another internal 5th, and so on and so forth. So this is the, and so on, and so we have, going backwards, this 4th, number 4, is on the date of February 8, to be precise. A intraday chart and a subsequent slide will show that a little more clearly. Didn't have space graphically on the daily to make it crystal clear, but that's on the date of, as the hourly chart will show in a few minutes. We'll see. That's on February 8, and it represents the fifth wave. Again, the principle is there is a specific, based on Elliott and other people's research, when you have between 4 and 6 fifth waves stacked like Russian dolls, one inside of the other, you have this phenomena of a top or a terminal point, a top or a bottom. It could be either one. Okay, so I believe we have at least 5. 1, 2, 3, 4, 5. This fifth wave, everything to the right of number 4, is inside of this 5th, everything to the right of this 4, and so on, and this 4, and so on, so on. So that's one factor that I believe, if we are not at a terminal point, we are near so. Okay. And then, so put that in mind. Also, the fact that we achieved this top at a time point. What time point? Yesterday, to February 15. And simultaneously, although I didn't mark it on the chart, again, I think another slide will show it, my price point was 23.50. I'd worked that out a few weeks ago. Yesterday's high was just literally a point or a few ticks, literally. I remember it was maybe 15 minutes before the close yesterday, I was talking with a coworker saying that the market's at we had an intra-period high of 2349.75. So in and around my price target of 23.50. Interesting. Could it be coincidence? Certainly. But when you have, at what point does very different things all lining up transcend or move beyond coincidence? We want to play on probabilities, so that's the thrust of the analysis. All right. Okay, so coming back, I'll come back to that because this represents a tangible trade, short-term and long-term, as I'll explain at the end. But from an intermarket standpoint, this is a trade I'm already in. We're long gold. For a number of reasons, these are my time points. The vertical lines represent the time points for gold. February 21st, so that's next Tuesday, a week from this Tuesday. Interesting. Subsequent to that, March 27, further out to that, May 1st, and then I've worked out into the June. I can work out as far as I need to, but it's no need to because they're not of immediate concern or urgent importance at the moment. They will be ostensibly when we get proximal to those points. For now, my most urgent interest is watching to see the behavior of gold prices as we get an inch closer and closer and more proximal to next Tuesday, the 21st. I'm not certain what to make of it, but if we continue to see appreciation, anything can happen. We've been moving up since yesterday's kind of low intra-period, and I expect further appreciation. If one is not long currently, and we got long back in here. I've been long a few weeks now, or this is a daily chart of April gold, and so we've been long for a few weeks. If you're not long, I was telling people off of this recent top, this is about a 38% pullback of the move from this bottom up to here. I was saying utilize that. Since we're now looking like we're resuming the move up, I would hold off and watch and see. Either one of two things. Strategically, either to take out this recent top and or see where we are when we come to next Tuesday, the time point. Time points again are in a simplistic way. It's not perfectly precise, but for those of you who are not familiar with how to interpret time targets for which you have confidence that you've generated, the beginning thing is just ask yourself, what is the market doing as it arrives at that time point? If it's trending down, assume a bottom is more likely in a revert. Trade the reversal is the idea. And that's an assumption. It's not always going to be correct because there are other extenuating, complicating factors, but as a starting point. So depending on where we are, if one is on the sidelines, I think we have a great opportunity and I'm bullish overall. But we shall see more precisely how this plays out. One of the reasons I am bullish is This is the mid of December 17, 2015. This bottom, a complete cycle played out 363 days, 2 days short of an exact calendar year. From this bottom over here, December 17, 2015, to this bottom, December 15, 2016. The entire 8-wave cycle, textbook example of Elliott wave structure. Here's your 1, here for those of you who are interested. 2, this is your 3, all this chatter in here, A, B, RTB wave, C of 4, and you're up to the top, marking the end of the bullish component of the cycle, and then A, B, C. Perfect textbook example. That is Elliott, and that's an impetus as to why. So there's no mystery as to why the market's moving up. What happens at the end of a cycle? A new cycle repeats in the same trend or directionality of the preceding cycle, serving and progressing market motion further through time as it evolves. All right, but here's an interesting point. Let's say you didn't know the first thing about Elliott. You understand a Gartley price pattern. It is a perfect Gartley to the tick almost, if not perfectly. Look at this thrust from this bottom here, the entirety of the bull portion of gold, up to the top on July 6th. This top, I didn't mark the date, but it is July 6th, 2 days after the holiday. The degree of retracement is exactly, like I said, to the tick. That's why I put this up here. Notice the 78.6 Fibonacci for those of you who are Fib analysts. This is a price analytic. It's a price reason. So you've got 2, there are actually many more things I'm looking at, but those are 2 very big. This is a big Gartley playing out over the course of a year, and so we're not at all surprised. Do I expect the market's going to go to the moon in one full swoop? I'd love for that to be the case. I doubt it very seriously. 80% of the time you see back and forth motion. Thus, this could be the 1, this could be the 2, this is odd for a 3, but I think we are in a wave 3. I'll have added clarity on that when we get to next week, Tuesday, the 21st. But suffice it to say, easy, my immediate price target for gold, and this is pertaining to April gold, 1262. We closed today around 1239.90, 1240. 1262 is an immediate zone of overhead projected resistance or target. Beyond, we take that out, we're going to 1289. Then more ambitiously 1316. I've already worked out numbers, but these are the immediate set of numbers in price, the corresponding correlates in time in gold. Same analysis applies, folks, for silver. I just didn't, the same dates. Now, there are differences for the 2 because I also use, don't be spooked by what I'm about to say, there are planetary cycles. Silver is very sensitive to certain lunar cycles, shall I say. If I just lost some of you, act as if, let's damp out or beep out that part of the tape. Think in terms of numerical mathematical correlation. Needless to say, what's important is the proof of the pudding if this stuff works. But I didn't put in the added lines here because they're essentially, more or less, it's not exactly true, similar to the structure, the geometry of silver, gold, and platinum. Notice I haven't said anything about platinum because I'm not trading platinum because of the low liquidity issues there. But either one is appropriate. Whether you're long in gold, whether you're long in silver, it is an appropriate strategy, I believe, right now. Now, if you're on the sidelines, again, strategically, I would not establish my long position right now. I would wait to see where are we down lower from where we're trading at the current market price of gold, 1240, 1239.90 is the close today. Notice this was printed out the night last night at 1237. We were trading at 1237. We moved up today, 1239.90, just under 1240. I think we hit 1240 intra-period. If we're moving up and we continue to trend higher into next Tuesday's turning point, February 21, we might have a little pullback. There's back and forth 80% of the time. Or alternatively, if we see trend going down into that, I would use any pullback as an opportunity to obtain an advantageous long position. Or so depending on what happens, one of 2 general contingency strategic ploys you might utilize. On a breakout above this little double top, establish your long, buying the strength. If alternatively we don't see that, and we arrive at this point at the current level or somewhere below this level, look at that as an opportunity to get long if we move down into this, because it would be a bottom-like in all likelihood. And same strategy for silver. The structure is silver. I didn't show the entirety of the chart, but this is the end of the entire bear market cycle. This bottom here in December, this is the same off, maybe it's a different date or two, I can't recall the date. For gold, it was December 15 of 2016. Silver, if it's not exactly the same, it's nearly so. In that first week or so, or third week or so of December of last year. And then we've been rising ever since. We have a very shallow retracement, so for those of you who are trend enthusiasts, measure the magnitude of the pullbacks as an indication as to the strength present in the thrust present in a market, and thereby the likelihood of a trend persisting. Okay, corresponding price targets for silver. My immediate overhead target, okay, the silver today closed at $18.07, just around 18. Last night we were at 18.01. The close today 18.07. We intra-period reached new highs, but we are at 18, just about 18. My immediate target overhead, and this is basis the March contract, 1857. We take that out, we're going to 1925. Mind you, the Gartley, which applies to both the silver chart and to the gold chart, indicates conservatively a return back to the top that came in the middle of the summer, July. So for gold, more ambitiously, we take out 1316, just under 1390. 1389 is the number. I didn't put that on the screen for gold. I don't know what the corresponding number is for silver, but you can see. You can just eyeball it. We're trading up here. This is the top, July 6th or 5th or 4th, whatever. It wasn't the 4th, but it was this around the 6th, I believe, the same date in gold. And you can see it's roughly, it's over $21 an ounce. We're trading at 18. So in silver, every dollar is 5,000 per position. In gold, every dollar is $100. Different scales, different calibrations, etc. It is what it is. Now, that's for the futures. For those traders who trade on the security side, gold and silver mining stocks are appropriate. We need to appropriately filter for those, or an ETF. GLD, SLV, I know are two common. There are 2 or 3 others that I'm familiar with. But now, this, again, I've noticed I'm not saying anything specific to strategy. Do you buy the underlying shares? Do you buy options? Do you do a spread? That's a function of the totality of who you are, or should reflect the totality of who you are. How much funds you have, your equity level, your tolerances for risk, your strategy preferences, etc., etc. But more or less, this is providing the view. We want to go long. You might expect, well, if I'm expecting to have a bias to expect a turnaround in stocks, that would serve to bid up metals prices. Maybe, maybe not. Yes, over the longer term, not always immediately. Different circumstances from an intermarket standpoint of trying to figure out will come into effect at different times. What's important is that the immediate time point for both gold, silver, and platinum, even though I would not trade platinum unless you extenuating circumstances, is next Tuesday. So watch and see. Notice silver has been leading gold. It has been evidencing a greater degree of strength. Notice notice in the previous slide, we had a little turnaround in gold. Not so pronounced in the silver. Silver tends to be more volatile. It has tended over the course of my career, I have tended to prefer trading silver. Either one, the specifics of which would be more, again, reflecting your preferences and based on particulars that define your style of trading. Okay, but these are these are position trades. The guideline of rotation for timing is utilized. I will be using this. We'll see where we are by the middle of next week in both gold and silver, and I'll kind of get a sense as to the duration when, and try and fit to see whether or not each of the respective price points are going to correspond with one of the corresponding time points. That's a trickier thing, but that's what we do. Okay. Again, just a reminder, I'm bullish bonds, very much so. Short term, short on the dollar. Mildly bullish on oil. I'll explain that in the next slide or two. My view on that. But that's a riskier play. The more certain plays are long the bonds right now, short the dollar right now, and then but through the next month. But after the meeting, I'm assuming we see the Fed raise rates. We're gonna launch the dollar in a new bull market. But in the interim, between now for the next month or so, I'm expecting some declines, and so as to complete the corrective phase that I think the U.S. currency is in. All right. Okay. Metals, yeah, as I've just indicated, it's wildly bullish there. I'm already established. If you're not, we're going to be looking at various strategies in the next few weeks to months on how to pyramid to existing long positions in both gold and silver, or establish new ones if you're on the sidelines. Stocks, long term. When I say long term, in this case for the equity sector, 2 to 3 years out. But short term, my bias, as you'll see in a minute, is short. Go short, as you'll see. Just a quick review of the relationships to the various major market sectors there. This is corn, for those of you who trade agricultural issues. I have been long in corn for months. I got long back in, don't even remember, it's been, I think, somewhere here in November, in what was the December contract, and then rolled over to the March. So I'm currently long in the March contract. I am bullish corn of the agricultural sector. Curiously, soybeans is a marker of inflation. That's an odd intermarket correlation, but I'm long in corn. One thing that has been problematic for me is the amount of, I think this bottom here, I'm pretty certain, is the end of a bear market correction back in the fall, last fall, the end of the last quarter of 2016. I believe everything, the appreciation is the start of what will be a long-term, multi-year bull market. I think it's just biding its time. It's taking a little bit long to get going. And this is, if you look, if this is a wave one of a new, what will be a long-term bull market. And by the way, when I say long-term, to give you perspective, for those of you who are familiar with Elliott nuances, this is a little one, that will be a little one of a larger one. This would be a 2, because if you saw a long-term chart going back 5, 20, 10, 15, 20 years, this bear market lasted for years. Okay, so this just moved for a few months is just the internal one of a larger degree, one that might end up at one of these price points that I've marked off with the horizontal line. This is a little mini 2, and I think we're in a 3. We're seeing nice price action of late. What's important from a time standpoint for corn in particular is March 7. That's my next tangible time point that I've worked out specific to corn, March 7. That's not saying necessarily I'm expecting the market will run unabated, uninterrupted, unhindered, higher in between now and March 7. No, but all it tells me is to expect change. A most important one, is an outright reversal on or about March 7. We are right. The reason the market topped out yesterday where it did is it's at a price point. These horizontal lines represent zones of overhead resistance in this case. We are trading in corn. We closed today and basis the March contract about 373.25. Last night when I printed this out, we were at 377. So we had a little pullback today. We have to break through this area, this price area. That's a resistance. So I'm not surprised, but I believe we will. So on a break strategically, if you're on the sidelines as far as establishing long positions in corn or an ETF or any security that would track corn prices and map it efficiently, wait for a breaking. I would either one of two things, depending on the magnitude and extent of a pullback, either watch that using Fibonacci retracement levels, etc., or buy the strength if we break out. Either one. Assuming we do that, the next level is 397. I didn't mark the prices here because time. 397, we break about 415. Let me just give you that quickly. 397 is the next. Okay, we're currently at a zone of resistance right here. That's why we topped out where we did last night, or yesterday's close rather, just about, what is that, 379, or 378.90, somewhere in there, or in a quarter. Just under 379. We break through 379 per bushel. We're going to 397. We break through that. 4.15, $4.15 a bushel. We break through that. 438, or no, 433, I guess is, or yeah, these are pennies. 433 per bushel. So that's a respective zone, listing or ladder or spectrum of overhead price targets for corn, if you like agricultural markets. Oil. This I'm lukewarm on, but this is, I'm pretty convinced, is a bottom in oil prices where I have letter C. I'm not, you can see clearly I'm not, this is where the commercials are at their largest net short position that they've been in for years. This is going back 5 years. That's ostensibly somewhat bearish, but not too bearish. They're primarily short 90% of the time, so you got to put it into a context. Here's the thing about oil. I don't see anything that sticks out saliently as a good opportunity edgewise in terms of spectrum of odds. I do see structure here off of the C. This is a little 1, 2. This is your 3 all. This is your correction 4. Either this is a 5 or we're still in a fourth wave. And so I think my bias for energy, oil in particular, this is the weekly going back 5 years, WTI. This is the April contract of crude oil continuation chart. All right, oil settled today at 53.82, so just around 54 bucks a barrel. All right, 53 and a half basically. This was printed out last night. We were at 53.82, so we had a little decline today in oil, or a little moved up a little. Excuse me, 53, 54. We had settled about an hour ago at 53.82 in the day session. All right, so here's my thought. This is a little fractal. This is the daily chart of April oil. A perfect textbook example. You can see 1, 2, textbook 3. By the way, I didn't put it in, but this 3 is exactly 1.618, the length of this 1. If you can see it with your eye, great, but I had it last night when I was doing this. But here's what I would do in oil. If that's correct, just on this scale, on the daily chart, you can see where we are in time. I just highlighted a little channel here. That's classic wave 4 activity, extended in time, restricted in price. Here's your A, your B, your C, your D, your E. Well, if it's a sideways flat, or if it's more of a triangular, a classical bull flag type structure, if it's the E wave, which structurally you have a number of shifts or rotations to suggest it very well could be. Doesn't have to be, but it could be. It's not. We're consistent with our structural tenets of the theory. Then it means there's another impulsive move to the upside, a fifth wave. And your 62% extension of 1 through 3 is going to bring you up to this horizontal line, which is $59 a barrel oil. We're trading at $54 or 53.82, 54, let's round it off. So it's $5 of appreciation. Every dollar in oil is $1,000 per position in the futures. And then you can do an ETF like OIL or USO, I think, is another one. They're also, or an oil stock of some sort. So I am not excited about this trade as much as I am as the long bond position, or what I'm about to say to complete today's program, the short in the stock market, potentially. The immediate trade you want to do, short the dollar, long the bonds. Those are the two trades. If you can only do two, depending on your resources, those are the immediate trades. Short term, go short the U.S. currency. Short term and long term, long Treasury instruments, notes, bonds, etc. The nominal, not the rate. We're not talking interest rates. I am bullish on the nominal level of 30-year Treasury and the 10-year notes. That's what you want to do. However you do it strategically. Those are the trades of the moment if you haven't, or if you're not already positioned in such a way. I would place 80% probability on those outcomes. All right. Now, this trade, I've got some evidence to suggest it, but I could also make a case. I'm not thrilled, but if, is a shorter term play, there is evidence to suggest a little appreciation here in the oil sector, and also from an intermarket standpoint, to the extent I am expecting some pressure on the U.S. dollar due to the inverse relationship between oil and dollar. If dollars declines into the Fed meeting next month, a month from now on the 15th of March, then that would tend to be a component that would serve to bid energy prices, all other factors. But that doesn't take into account, as we certainly should if we're trading oil or energy sector, political contingencies, OPEC, etc., international situations, etc. So be mindful of that as a backdrop, even as a technician, okay, if you want to, because ultimately at the end of the day, but there is potentially a spread of about $3 to $4 of return, each dollar being $1,000 per position. So it warrants highlighting and mentioning, if nothing else. All right. Lastly, coming back full circle to this is the trade also. Two possible situations. Notice I mentioned previously I'm mildly bearish short term. I haven't done a trade yet. Again, I've been long since November 4th in the stock, or November 8th. We got long, got stopped out on the day of the election, and then re-entered later that day or that night, I forgot. And then about the first week in January, established long positions again. So we're long. So I sent the memo out yesterday pertaining to stocks in the United States and the stock sector in general, saying if you are long, tighten up stocks, get out of, you know, partial liquidations, etc. Certainly, here's what you would not, what I would not do right now. I think we're at a critical balance point of equilibrium, but we are at a point of change. I am 90% confident of that. I'm not 90% confident of the direction, but I am 90% confident something significant and abrupt could happen by the middle of next week at the latest. I would be amazed. 90% is 90%. So here's what I'm thinking. I have a slight bias to expect the downside. We hit our price target essentially, barring literally less than a point, 23.50. Here's the price target that I had projected. And at the time, either one by itself, singularly, a market arriving at a time point and or a market achieving a price point is significant. The fact that the two of those things occurred in the simultaneity of the confluence of factors attaches greater significance to the entirety of it all. So I'm expecting change. If we go short, the next slide will indicate more precisely some ideas on how to do it. But if it turns out it's a change that would be a continuation, and that often is preceded by a series of consolidation, sideways price action. We had a little candle. We were down today overall relative to yesterday's trade. I am not surprised given my bias to the short side, at least short term here. Okay, we had a hanging man type candle structure. I didn't print it out, so you won't see it, but it's a hanging man today, which is a little somewhat of a bearish indication. Again, I'm not surprised. But if I'm wrong in that bearish bias, my next time price target, is 23.67. It's possible. Here's the stacking of the fifth waves. This is 1, 2, 3, 4, 5. The next chart is going to, and so again, we're at that time point. My next time point for stocks, March 29, and then subsequent May 3rd. Now, the next chart is an intraday, and there's a possible sixth fifth wave. And this is the hourly S&P. It's just a micro view. Here is the February 8th. You can see if you can see it, but trust me, this bottom came in on February 8th. I don't know what time, what hour, but that's not important. What's important is that was the fifth wave that was embedded. Again, a series or a set of 5 fifth waves that are embedded one within another. When you look at, when you go down to the intraday period, when I went down in time, I could locate structure that is consistent with locating at least another fifth wave. Okay, so if everything to the right of this February 8th structure that was traced out on our screen as observed on an hourly chart is in fact another fifth wave, which I clearly think it could be, there should be 5 smaller segments inside of it. Well, this could be the one, this is a relatively shallow 2, but it could be, or this could be the 1, this could be 2, all this could be 3. Here's a clear 4 down to this little double bottom. This date comes in on February 14, yesterday, I mean 2 days ago, excuse me, the day before yesterday. And as such, that could be the 6th. That's why I put this question mark, a 6th fifth wave. The qualitative principle or phenomena or ideas, the more fifth waves that are embedded one within another, the greater the probability the market that you're focused, that for which, within which it is forming, will have achieved or be at a turning point. That's the principle we want to look to exploit. That's not saying a market can't turn without that. It's just saying if and when you observe that type of structural stacking, that's correlated 97%. That will be the consequential subsequent response. Okay, very good odds for my the way I see things. But so I see structure here. This is, I printed this out last night. That suggests I got to point out the opposite argument. This could be a 1. This could be a 2. This is a little short for a 3, but it doesn't break any rules. But this doesn't reflect. We came down further today. Okay, we broke through, and so, but either way, on further evidence, we're either at a top, or it's possible we could have another a final fifth wave and be congruent with this higher level of price, 23.67. Another 17 points or so is not much given how we've moved for the last year, back from January of December of 2015 all the way up, and then much less even going back even further, all the way to the long-term generic bull market in 82, or a bull market embedded within that starting in March 9th of what year was it 93? Yeah, the end of after the recession, 93. Okay. So this is I'm just pointing out here the hourly chart indicating a possible additional fifth wave, further strengthening my bearish resolve. Okay. Strategically, short entry. Here's a couple of things that are generic types of strategies one could employ to exploit and determine the directionality of your trade. There are a couple of things you can do. Number one, let me just say this, and I discussed this yesterday with a coworker. When we were right around in here, even before this little overnight market stuff formed, when we were up near the top, maybe one candle, 1 hourly bar had formed, I said, he was saying, why don't I short the market? And the idea is, yes, you can certainly, and the obvious thing is you could go short, regardless of your time frame, whether you're a short-term day trader or long-term, it doesn't matter. And if you're wrong, just put a tight stop. Yeah, you can do that. If you choose to be a little more conservative, you would utilize some type of trend line violations, connecting this bottom to this bottom, and then on a break below that trend line. When you have a succession of higher and higher bottoms and higher tops, indicative of trend persistency. When both of those phenomena are gone, given whatever time period you're looking at, it's clearly an indication that the trend that has been in motion is more likely over or nearly over. We're not seeing that, so that's an argument supporting the bullish case for stock prices currently. Okay, so let this serve as a filter to the extent you choose a more cautious entry or probing or testing of the short side of the market. But today, although this slide, I didn't have time literally to print this out, but suffice it to say, the S&P was settled today in the day session, 2346 and a quarter. So this was printed out at 2348 and a half late last night. We ended up today at 2346. So the market's below this trend line. So on that violation, that would be of this trend line, if you're using that as a filter by which to go establish a short position, it has been met. That would indicate established shorts. If you're a little more cautious, but the price you pay is you give up some potential return on the front end of the move, notice I've put a Fibonacci retracement. I retraced from this bottom here. That's the you can see that on the daily chart. That's essentially February 1st, January 31st, all the way up to yesterday's top. I did a fib overlay, 38% Fibonacci level. You could utilize that, a violation of that. In other words, if the market breaks down or closes or whatever below the 38% level, which is this, see this, 38, 2, 50, 61, 8. Those are your three critical Fibonacci retracement levels. So we're distant. That's the 38 Fibonacci level is at 2316 essentially. So we're a ways from that. We're at 2346. But you would be willing to forego all of that on the bet that there's a lot more to come. And probably I'm guessing that would be an okay. I believe that would be a valid strategy. Also, I have a slightly more aggressive strategy. I tend to, you could, if I'm long, and I have taken off partial profits, but I've also just adjusted my stop, my sell stop to protect my long position. If one is long, you might do something like that. You can do an SAR, stop and reverse, or you could just, if you're on the sidelines, you could just, here's a bottom, here's a bottom, the two bottom back, or the two, well, yeah, it's kind of a corollary of the two bar back rule, or 1 day. Anyway, often what I do is I'll identify if I'm long, or find out where the market is, and in two zones of support if you're long, if you're planning to go short below. And so notice that that's close. 2320 is just 5 points above the 38 fib level. So they're essentially confirming one another. So a violation of either one of these, if you're a little more cautious, or if you're more aggressive, the idea would be to trade a break below this some such trend line such as this, which has already occurred with today's trade. Again, we closed today about an hour and 50. What time is it? Oh wow, I got to end soon. 20 minutes, hour and 20 minutes ago, we closed at 2346 basically. So those are two strategies that would apply. Now, on the other hand, just to talk the other strategy, if it turns out that we take out yesterday's top, the day top, go long. Get out of, stay long if you're already so, or if you're on the sidelines, if you're on the sidelines, establish new positions in any of the major indices, because that's an indication consistent with this, we're more likely going to have at least one final leg up into the price zone of 2367 basis the S&P. If you're trading spiders, it would be 23 or 238 or 237, excuse me, rounded up basically, or some such number. Depending on the index, the numbers are going to be different, but it's geometrically the same. Each index, the Dow, the NASDAQ, etc., these are all calibrated and scaled differently, but more or less the proportionality is the same. Okay. All right, so folks, any questions before we call it today? And I see that, yeah, I ran over, but I still have a few minutes, and there's no session scheduled after me, so we have some time to go back and review any questions. Okay, let me just do this as quickly as I can. Sorry for taking too much time, but what about the upcoming, someone's saying, what about the upcoming elections in France and Netherlands? Well, good point. Again, I'm not a fundamentalist, so I'd have to, I don't know, obviously. It will, I know how to address that because that's very easy to do. I started my career as a fundamentalist, but you want to see, here's my first thought. Think back to one of the first or second, in the first 5 slides where I was pointing out the intermarket connections. It's the dollar. Now you could drill down even further to that and say, well, what are the drivers of the U.S. dollar? Well, monetary policy, fiscal policy. It was curious that just the other day, 2 days ago, I think it was Tuesday, I think Janet Yellen at the Fed had testimony before Congress, essentially in a not so subtle pointedness to Donald Trump, said, let's make sure that we coordinate fiscal policy with monetary policy. She said it's not, I think, and I'm quoting, she said, I don't intend to opine about, fiscal policy. That's not the mandate of the Fed. Regardless, folks, regardless of what you think, the legitimacy of the central bank or central bank type entities, that's neither here nor there. She made the point, I think, in an overview for the purposes of stabilizing our market, our capital sector markets. So coming to your question, look at, I don't know, because I haven't stayed up on it, I can easily find out what the ramifications are, but the idea is to interpret the elections and with a view in terms of the reverberation that it would have on any sovereign state and how it would play out on the U.S. as a nation, as a national sovereign entity, and internally, our policies and how they relate and reverberate and interrelate to whether it's France or in Europe. I do know that there has been for some months, if not at least the last year, growing weakness in the Italian banking system, and to the extent we are all connected as trading partners and counterparty entities, this will play out. There will always be, again, I'm not focused on fundamentals, but it's quite easy to locate and identify the fundamental factors that are relevant and germane to what's playing out on your chart. So let me come, I'm not trying to sidestep the question. I know that again, I haven't kept up on the situation in France and the Netherlands, Griff, but again, I'm not. But that's how I would interpret it in the context of what would be the, however, whatever the plausible outcome, possible potential outcomes are in those elections, what are the responses that I can expect the U.S. and then generate a policy and a view based on that. What I would do is I'd be looking at the euro, again, given my strength in the dollar, my views of the dollar, immediate, whatever your time window or horizon is. But that's how I interpret it, attempt to. Again, if I hadn't thought to review, the political scene in Europe primarily, but certainly it will make an impact, and there's a feedback that is going to have, back and forth ramifications to our markets, clearly. I know I'm not answering your question directly, but only because I have not up on moment by moment in the day-to-day proceedings. I am aware that there are, upcoming elections. I just not on the details of such. But again, were I to do that, it's easy to extract and derive that information. I would then ask myself from the chart standpoint or whatever market specifically you're looking to, how does it reconcile or dovetail or not, and then generate some longer or whatever your view window is that are consistent with that. All right. So let's see what other questions. Low on the 8th was at 950. Okay, so you're referring to the, I'm assuming, the time point that was marking the end of a particular fourth wave of a certain degree, and as such the onset of the corresponding similar degree fifth wave for the stock market. Yes, thank you for giving me that point. Thanks. I indicated, someone's saying I'm indicating I'm bullish on bonds and that I do expect a rate increase in March. How can you be bullish the bonds? Well, good point. It's a question of relative importance. In general, bonds are inversely, in general, let me emphasize that, in general, there's an inverse relationship between nominal bond or treasury prices and interest rates. So yes, to whoever is raising this point, when you raise rates, that puts pressure on the nominal level of the 30-year treasury, 10-year note, wherever you are on the interest rate curve, yes. But that's an immediate response. More macro or longer term response and an override, that's one relationship. But a separate relationship, which I would submit in response to your question, to answer your question, to be succinct, is a more global sensitivity that Treasury instruments have as an attribute, is that they, in general, reflect monetary policy, or and fiscal policy, economic regime status and policy that is constituent to that. So if you have, that's why I said, I kind of glossed over it and I said it's facetiously. Nevertheless, it's not a facile point. It's a very real one. In general, things that are generally accepted, consensus view, bad for humanity and our economy at large, just generally recognized, general across the board agreement, that tends to be price supportive. And you can think about from a cause and effect standpoint why. To the extent we get good news, that tends to put pressure on the nominal treasury price levels. If we, on the other hand, get bad news, one subset of or type of bad news is the economic engine. People are out of work. More jobless claims are being filed. When in general things are in the doldrums, things are not looking good as far as in a general sense, things are bad overall as human beings first and foremost. The Feds that's where the regulatory capacity and utility of the central bank comes in, and they will tend to either maintain a low cost of money policy or interest rate policy, or refrain from raising rates. Either one will tend to be price supportive for Treasury instruments. That overrides the actual more micro adjusting, whether we open the window, we increase the diameter and thus the circumference of the tube through which money can be, lent out to the member banks, and that serves as a reserve, and based on a certain formula or algorithm, they lend and make it easier to borrow for growth, supporting growth in an economy, or the opposite, whether they narrow the tube and constrict it so that less money comes out and creating slowing the, reining in the progress of growth, let's say. So that's the answer. You can have hawkish or tightening of monetary policy and still rising bonds, assuming that the degree to which the money supply is lessened, thereby putting up an inverse pressure on bonds, the net impact of the lower monetary supply is esteemed and perceived by the broader capital markets as positive. In other words, maybe it's saying it's counterinflationary, and the bond market in turn says, oh, we've had a rate increase, let's say, or we've had a series of increases, therefore that's one storm cloud that we've evaded, and still things are moving, it's not too much, it's just right, and as such there's reason, we've gotten it out of the way. So you can have what on the surface superficially seem to be mutually exclusive activities and still see price action moving in a certain way. So yeah, I'm expecting a rate. Here's the thought to your question, really. I mean, yeah, everything I just said is appropriate and valid. More importantly, though, is I don't know what I don't know. First, it might be. Here's another thought. Here's really what I want you to think about if you were thinking about that bond trade. Very to the point. I said I expect the Fed, 70 whatever percent, whatever probability to raise interest rates next month. That's not a guarantee. Now, also let me emphasize, I think they will. I'm pretty certain they will, barring some catastrophe. Now, also remember what I said. If bonds go up, that means it could be. When I said I don't mean to be a harbinger of gloom and doom, but I do understand that when things go wrong or bad, that tends to be price supportive for a Treasury instrument. It is what it is. Now, overriding all, but focus on that rare less than 5% of the time across the board of the 50 or so liquid derivative markets in the US, just the United States alone, where you have an extreme, the largest commercial net long position, and you have simultaneous augmenting that, the polar, almost, not perfect, but a mirror image on the part of the specs. That is extremely powerful. I will make money on that numerous times. Paul Tudor Jones made a fortune between that strategy and spread inversions where the front month trades at a premium to, that's another thing. So just on that. So what does that say? I don't know definitively, but what it does tell me and suggest to me from just putting all these bits and pieces together, again, on the one hand, I have reasons to expect the Fed will be raising rates. Maybe they will, maybe they won't. But the fact that the commercial positioning in that market is at the largest that it is, net long, and simultaneously the small traders don't know what they're doing 80–90% of the time, or the opposite, tells me something or things will happen. Whatever policies, whatever events we need to see will be price supportive for treasuries. It might be, again, to your question, that you do have an increase in rates. Maybe it will be perceived by bonds as not meeting what was projected, or maybe it will be some qualification to the magnitude or how they raise, the policy that's enacted. Or maybe we just have weak reports between now and then, further delaying the rate increase, etc. It could be any number of things. The explicit details of policy and events and fundamental events, very difficult. I don't have a crystal ball. This is why at 27 years old, I started at 24 and purely fundamentals, learned a lot, had a plethora, a foundation of information burgeoning all the time, but not consistently being able to translate that to consistent dollar and cent profits. Okay, how can I get a hold of you? Someone's asking. Tom, I will contact you. I haven't forgotten you. Okay. Any further questions? I think that's the end of the questions. Folks, it's been a pleasure. If you'd like further information concerning any of what I do, any of the specifics of the trade, more specific strategies, or any of what my coworkers do here at Pacific Trading Academy, you have the contact information again, 800-339-8588, as well as the website. Also, one final note, I recently wrote a chapter in an ebook that is very interesting on where I elaborate more on the reasons why I'm expecting the appreciation in the precious metal sector as a long-term play throughout the rest of the year. So you can contact the people at Pacific Trading Academy if you'd like to obtain access to the ebook. And there are 11 chapters. I wrote one of them, and you have other traders of interest, varying interest in disciplines and perspectives and views and different approaches that complement what I did. So again, you can contact PTA, Pacific Trading Academy, for any of the above. And once again, it's been a pleasure, and looking forward to seeing you the next time. Until such time, I wish you the best and great trading in the days and weeks to come.